Since the inception of the ETF or the exchange traded funds, the investment landscape has completely changed. We have seen a very significant shift in investment strategies, often leaving it and always had it to professionals, to being able to kind of self-manage all of your investments yourself. And in today's video, we're going to be looking at Vanguard funds specifically that I know are standouts that I do talk about. Now, of course, I do not pledge my loyalty to any company. If it's Charles Schwab, if it's Vanguard, regardless of who it is, I like the funds for the performance of the funds, but I definitely wanted to cover this because I got a lot of questions about Vanguard and really why I choose Vanguard funds. Now, of course, this is one fund family that everybody knows. When you put the name Vanguard out there, it is really synonymous with low cost, tax efficient strategies with the ETFs that they do have. Now, of course, they offer currently 86 ETFs. Now, in this channel, we probably talked about a dozen of those, but as you can see from some of these, 50 of the funds are classified as stock ETFs, so 50 of the 86 that they have, which means they carry a moderate to a high level risk, which is assessed on Vanguard's risk scale. Now, of course, when it comes to a riskier investment, and honestly, this is very dependent on your age, where if you're in your 20s, 30s, 40s, definitely taking enough risk within your portfolio is going to yield you some good returns. Even if we see a market downturn, you have a multitude of years to go ahead and recover with market upswings. And we know some of these, which you've known by name or we have invested in, and I do hold in my portfolio. The first one we're going to look at, the affordability of the Vanguard ETFs is really the key factor because of the cost. When you look at a financial advisor, you might pay 1%, you might pay 1.5%, you might have a flat fee, which I know a lot of them don't do the flat fees anymore. But overall, if you're putting out 1% over the course of 30 years, you're giving away a big chunk of your portfolio. And of course, this comes with growth, this comes with the compounding factor. But if you don't want to do the time and effort and do all of your own investing, definitely seek expert advice. Now, of course, the first one we're going to look at is the Vanguard S&P 500, which is the VOO. Now, this one, of course, is the 500 largest companies within the United States. And this is one that Warren Buffett always says everybody should own the S&P 500 index because, of course, going in a fund like this, we have seen an average of 10+% every single year when you kind of annualize it, 10% return in the VOO, which is huge. When you think of stocks at roughly 5%, when you look at even high yield savings, running about 5%, getting a 10% return on average with the Vanguard, as long as you have the time frame, it is really effective. And another one is the Vanguard Total Stock Market Index ETF, which is the VTI. Now, a lot of people like to do this on a broader scale, which of course is going to be a little bit more of that risk mitigation. So this actually invests into all of the stocks that are within the stock market. Now, Vanguard, again, the S&P 500 is only 500. When you look at the VTI, it is in all of them. Now, of course, the big standout with these two is it has one of the absolute lowest expense ratios that we do see of any ETFs, which is a 0.03. So the more that you're putting in here, essentially you're paying $3, and I believe it is on every $10,000, which is kind of crazy to think of a 0.03. So definitely seeing some very good low fee ETFs right there. Now, on the other end of the spectrum, Vanguard International High Yield Dividend, or the VYMI, we have talked about in here, of course, for the dividend yield, and the Vanguard US multi-factor ETF share, the VFMF, are the most expensive that Vanguard possesses. However, the expense ratios on these are a 0.22 and a 0.18 respectively. But when you think of it, again, you're talking about, if you're looking at 1%, if you're looking at 1.5%, to go ahead and manage the funds. If you picked up the Vanguard funds, you're only going to be paying a fraction of that, even on the higher end. Now, of course, it really comes down to performance. And unfortunately, the previous or the performance we've seen in the past is not always indicative to what we're going to see in the future. But when you look at long-term and short-term performance with these Vanguard funds, Vanguard S&P Mid Cap 400, the IVOG, and the momentum factor, which I have personally, and I do have my kids invested in the VFMO, I absolutely love. And of course, the Vanguard S&P 500 Growth Fund, or the VOOG, which again, you have to get some of these down, might have to watch it more than once. But overall, looking at the gains in here, you think about the returns, the average returns. When you look at like the VFMO, you're talking almost 10%. Again, very similar to that. And this looking at the 10%, very similar to like the VOO. And of course, this is only this year, guys. When we talk about the IVOG or the mid cap, they are over 10%, 10.04. When you look at that momentum fund, 9.27. Even when you look at the growth fund, 8.55, which is this year. That is right, guys. We are almost seeing a 10% return. Now, traditionally, when we see years of really hitting a new high within the stock market, within the S&P 500, majority of the times that is a record buster and a record breaking year for investments overall. So again, I'm thinking that when we're seeing it really up like this, again, thinking of the momentum fund, which in the last 5 years, that momentum fund has returned over 100% in 5 years, which is kind of crazy. So what about Vanguard and their worst performing funds? When you look at the global equity funds, or even look at the small caps and even the small cap index, the ETFs like the VIOO or the VIOV, some of those are the worst performing funds, but overall ranging from 2 to 5% that they are actually down in the Vanguard family. But then you look at the last 10 years, this is where it gets crazy when it comes to investing. When you look over the last 10 years, you look at the Vanguard Information Technology, which we know technology has been huge, but you start coupling in artificial intelligence, looking at the performance of like an NVIDIA. The VGT is up 509% in 10 years. That is right, guys, 509% in 10 years. Even the Mega Cap Growth Fund, which is the MKG, is up 319%. And the Vanguard Russell 1000 Growth ETF is the VONG, is up 316%. So just imagine 10 years ago, if you put, let's say $10,000 in there, fast forward your 10 years, you're up 509% in a decade, which is kind of crazy. You talk about the 10% growth that we normally see with the VOO every single year. Again, when you look at this, it is kind of insane with how fast some of these have been building. Now, of course, when it comes to Vanguard, you can go ahead and you can split these Vanguard ETFs a ton of different ways, and you can actually do this by investing fractional shares through M1 Finance. I do have a link down below, so definitely check it out if you're looking to get into invested. And of course, let me know in the comments what you guys think about the video. Give it a thumbs up and subscribe to the channel. Let's continue with this. Now, looking at some, again, of the worst performers for the last 10 years, looking big picture. Even looking at the very worst performers, we have everything ranging from the VOO, which total return on that was 223%, which again, over 10 years is kind of incredible to see that kind of a return. But even as the very lowest performing ETF, which is the VNQI, which is again, that global US real estate, over 9% return on this. But again, of course, that's over 10 years. So not seeing a very good return, but still almost a 10% return over 10 years. So of course, when you look at Vanguard funds, there's a reason why I do hold 3 of the Vanguard funds. Now, me personally, I hold the Vanguard S&P 500. So I own the VOO. I also do hold the VY or the VFMO, which is the Vanguard Momentum Fund. And I also hold the VUG, which is the Growth Fund. Now, of course, they have a different segments, and of course, they do overlap somewhat. So the big thing that I do know, the VOO and the VUG do have a pretty significant amount of overlap. However, the big thing is when you look at that S&P 500 fund, they're holding 500 plus companies in there. When you look at the growth fund, it is holding around 220. So it has a very strong concentration in the growth side versus just being all of the sectors, all of the, the entire index with that VOO that you're going ahead and investing in, which is the reason why I do hold them. And then of course, that momentum fund is what I do hold for my kids. And I'm really thinking to get some money in there and investing on a regular basis, making regular contributions. That way, when they get ready to retire in roughly about 43 years, which again is kind of crazy, they can have the exponential growth that we're seeing from these Vanguard funds. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.